going to be listed as cash and cash equivalents, because remember, on the balance sheet, we list our assets based on order of liquidity, and therefore the fact that this is gonna, actually is restricted. We cannot touch it. This is not liquid, right? And so it's not gonna be part of our cash and cash equivalents. And the same concept with the compensating balance, because the loan is not due until 2024. That means that cash will also be restricted for this loan, and therefore is not listed under cash and cash equivalents. In terms of the U.S. Treasury bills, remember that we said 3 months or less. So if we have Treasury bills that are 7 months, then these will not be listed under cash and cash equivalents. So at the end of the day, let me just do it on the side because it's easier. We're going to have our checking, right, 14,200. We're going to have our savings. We're going to have the undeposited checks. We're just holding those on hand. Any petty cash that we have, and then treasury bills that are 3 months or less. Okay, so that will be pretty much the answer for that assignment. Questions? Okay. Next one we have Tracy Company. Okay, we're moving on to receivables. There are two types of discounts that are introduced in this assignment or this problem. The first one is a trade discount, and then we also have our sales discounts. Okay, so trade discounts we talked about means when we are purchasing in bulk. And so the trade discount is considered from the time that we are actually recording that journal entry for the sale. Okay, so there's no contingencies on the 25% trade discount. Is given right off the sales price. All right. So two ways to deal with that is actually we can take our 220 units and multiply that by $400 each, and then multiply it by 0.75, right? Minus the trade discount. Do we get the amount that I think we're gonna get? Yes, and that is equal to 66. All right, so that is net of trade discount. And that's the amount that we're going to use to record our receivable. Okay, so we're using the gross method. So with the gross method, on our initial, the sale took place on the 17th, right? On the 17th, that's the amount that we're going to be using, the 66. So we're going to debit accounts receivable for 66,000. Oh, I have 600. Oh no, it is 66,000. It is 66. 66, not 600. And then we are going to credit sales revenue. So I think they told us to ignore cost of goods sold, but you know that normally when we sell inventory, we're going to have two journal entries, right? The other entry being a debit to cost of goods sold and a credit to inventory if we're using a perpetual method. Perpetual inventory method, which we are going to be talking about that for chapter 8, right? So how exciting. All right, and so on the 26th, okay, the buyer took advantage of the discount terms. And remember, the 2 in the front indicates 2% discount if paid within 10 days, okay? And so they fulfill the contract or the agreement of paying it within 10 days, and therefore they're entitled to the discount. So it will be the 66 multiplied by 98%. That's the net cash amount that we are receiving, okay? And then we're still gonna have to credit our accounts receivable for the 66,000 because we want to zero out our receivable. And then the difference is gonna go to sales discount. Okay, and that is 1,320. And sales discounts, I'm not sure if we said it here because I did this with the 200 class as well. So sometimes I get confused to who do I say what. But the sales discount is reported on the income statement, right? So sales discounts is treated like an expense and is reported on the income statement. So sales discounts is gonna reduce the amount of sales. So that's for part 1. And then in part 2, we are told that the customer didn't take advantage of the discount terms. And so for number 2, our first entry will be the same. Okay, so debit AR for 66 and credit sales revenue for 66. But our second entry, they're not entitled to the discount because they didn't meet the discount terms. And so that's going to be our entry without the discount. Okay, so the first part is with the discount. The second part is without the discount. Any questions? Okay. Now we still with Tracy. Okay, we still with Tracy, except that now we're using the net method instead of the gross method. Right. Similar to what we did in 200, if you recall that far back, pretty much the same. So we're looking at net method again. We treat the trade discount the same, so we're still working with the 66,000. All right, except that the entries will differ slightly. So for 3A, they took advantage of the discount. So accounts receivable under the net method is going to be the 66,000 multiplied by 98%. Or 64,680. Okay, and then we have our sales revenue of 64,680. So under the net method, we are assuming that the buyer is going to take advantage of the discount. And so on November 26, I didn't put dates on this, but November 26, where our cash that is debited is the 64,480. I'm sorry, 680. And then we have a credit to the AR for 64,680. All right. So in number 3B, 1117, same entry, AR 64,680 and sales revenue of 64,680. Okay, so that was the same. The second entry, because they did not take advantage of the discount, the cash received will be the 66, right? We still have to credit the AR for the 64,680 because otherwise we're not going to zero it out, and we want to zero it out. So that means that we are going to credit sales discount forfeited. Of 1,320, and we treat this, we are the seller, right? We treat the sales discount forfeited as revenue. Okay, so a credit will increase this account, and this is reported on the income statement. There's actually two ways to report this. This could be a decrease to cost of goods sold, or under our non-operating income and expenses, the other income and expenses section of the income statement. It can also be reported there. So either way is acceptable. All right. The next one, we are talking about returns of merchandise. If you remember when we were looking at chapter 6, I know it was very painful. For chapter 6, we talked about returns of merchandise as not being part of a performance obligation, right? We don't treat that as a performance obligation. I think these days that's granted, right? Pretty much any merchant is going to offer that to their customers, especially if they believe in the quality of their merchandise. And so how do we deal with these returns for accounting purposes? We said we are going to have to estimate the sales returns based on maybe historical and also our evaluation of current economic conditions, and we're going to come out with a percentage. So in this problem, they have estimated sales returns on current year sales, which are 2021, of 5% of sales. Okay, but we also have two tiers that we have to deal with. We have a return that belongs to a prior year sale, okay, from 2020 or 2019 or whatever. And then we also have a return that deals with current year sales, 2021. So how are we going to deal with this? So we said that in estimating our sales returns, we're going to be using a liability account called refund liability, okay? And the company began in 2021 with a refund liability of $400,000. That means that the beginning balance of this liability was $400,000. This $400,000 belongs to estimates that were done prior to 2021. Okay. And then we're also told that during 2021, Halifax sold merchandise on account of $12,500,000. Halifax merchandise cost 70% of the selling price. Customers returned $613,000 in sales for credit, with 338 of those being returns from merchandise sold prior to 2021. Okay, so this is part of that 400,000. Okay, so these are old sales. Okay, all right. So they want us to prepare entries to record actual returns of merchandise that was sold prior to 2021. So let's start with that. Okay, so for A, we're dealing with returns that were for merchandise sold prior to 2021. That means that the sales return was already accrued and it's part of our refund liability. So if we are going to refund anything to the customer, it will come from the refund liability account. So we're going to debit refund liability for $338,000, and we're going to credit accounts receivable, or it could be cash if these were cash sales, but they didn't say it was cash sales. They said it was all credit. So we're reducing their accounts receivable balance. Okay, so that takes care of A. So this is for the older sales, okay, prior to 2021. Now for B, We have record actual returns in 2021 of merchandise that was sold. So for B, we have our actual returns for the current year. So, oh, I'm sorry. I'm forgetting another part here that deals with the inventory. So we said our cost of inventory is going to be 70%, right? So 70% is the cost of goods sold associated with this refund, because we have to put this merchandise that they gave, the return to us, back to the warehouse. Okay, so 338 multiplied by 70% is 236,600. So this is going to be our cost of this is our inventory. This is our inventory. So we have to put back this inventory in the warehouse. So we're going to debit inventory for 236,600, and we're going to credit this inventory estimated returns. Because remember that when we first increased the refund liability, we debited inventory estimated returns. And I put investment instead of inventory. I said inventory, but I did something else. Okay, 236,600. Okay, so that takes care of the older returns. So now we move along to the current returns, current year returns, and I actually need to know that amount. So 613 were the total returns. 613 total returns, but 338 were for older sales, right? Prior to 2021. So that means that 2021 returns are the 613 minus 338, or 275. Right, so that's our 2021 returns. So, and 70% of this is going to be our inventory, right? Multiply by 70% is 192,500. All right. So for the current year, so that will be B. We have our sales returns. Okay, so this is 2021. So note that we're not debiting the refund liability. Okay, 275, and credit our accounts receivable of 275. And then we are going to debit inventory for 192,500 and credit cost of goods sold. So we're kind of reducing the balances in the cost of goods sold and accounts receivable by the merchandise that was returned in the current year, because we haven't closed the books yet, right? So we can go ahead and make these adjustments. So that's that. And then for C, they wants us to adjust the refund liability to its appropriate balance. So basically, based on our estimate, so we have sales of 12,500,000 multiplied by 5%. Our total estimated returns for the year is 625,000, and we customers have already returned 275. So that means that the ending balance in the refund liability account should be 350,000. Okay, so this is the ending balance of the refund liability account. Okay. So after we've done all this, so we started with 400,000 in the refund liability account, right? We have to do an analysis of the refund liability account. So remember that, maybe I should do a T account. Remember that refund liability, as the name says it, is a liability. Okay, so refund liability. So that means that a credit has a normal credit balance, right? Credit increases this account. So we started with a credit of 400,000 and then we reduced it by 338. So we currently have a balance of, we still have an amount in this liability of, what's 400 minus 338 is 62. And it needs to be, the ending balance of this account needs to be 350. That, oops, I hate when that happens. It needs to be 350. That means that we're going to have to credit an account here, right? The 350 minus the 62, an amount of 288. 288 will be the amount of our adjustment. Okay, so we currently have 62,000 in the account. It needs to be 350 according to our estimate, right? So we need to increase it by 288. So in C, we're gonna debit sales returns. Okay, so every time you're dealing with current year, you're going to be using sales returns. If you're dealing with the prior year, you're going to be using debiting the refund liability. So we're increasing our refund liability by 288,000. And we're going to have the inventory estimated amounts or estimated returns, which is 70% of our 288 or 201,600, and then credit our cost of goods sold or 201,600. Okay. Questions? This is similar to the allowance for doubtful accounts, except that in addition to that, we also have to take into consideration the inventory that's been returned. Okay, so I think it's a bit more difficult than the allowance for doubtful accounts. All right, and talking about allowance for doubtful accounts, here we are using, or we're supposed to compile or actually analyze our aging accounts receivable. Okay, so we have Daliwal Digital categorizes accounts receivables into 3 groups. Accounts that are not yet due, the percentage of becoming uncollectible is 20%. That's kind of high, but okay, 20%. Accounts 1 to 45 days is 25%. Accounts more than 45 is 30%. And so all we have to do is multiply the balance by the uncollectible percentage estimate, okay, to come out with a total ending balance of the allowance for doubtful accounts. And then we compare that ending balance to the beginning balance to come out with our bad debt expense adjustment. All right, so we take 216,000 multiplied by 20%, and that will be 43,200 okay, for the first tier. The second tier is 7,500, and the third one is 3,600. So we add these together to come up with the ending balance of the allowance, okay? And that ending balance is 54,300. For doubtful accounts, all right? And so we know that we have a debit balance. So if we have a debit balance, okay, so this is the, again, kind of similar to the refund liability. We have the allowance for doubtful accounts, has a normal balance of credit, but is listed under assets. So this is a contra asset account. I love that name. It's a contra asset account. All right. And we're going to, our beginning balance is a debit of 54,100. And our ending balance should be, according to our analysis, a credit of 54,300. So we are going to have to add the two, right? So if we have a debit, we add. If we have a credit beginning balance, we subtract. And so the amount of the adjustment that we need to make is 108,400. Okay. So we're going to take, or actually the adjustment is a debit to bad debt expense for 108,400 and a credit to the allowance for doubtful accounts of 108,400. Okay. Any questions? Okay, moving along to Colorado. Okay, Colorado Rocky Cookie Company offers credit terms to its customers. At the end of 2021, accounts receivable total 650,000. The allowance method is used to account for uncollectible accounts. The allowance for uncollectible accounts had a credit balance of 37,000 at the beginning of 2021, and 23,500 in receivables were written off during the year as uncollectible. Also, 1,700 in cash was received from a customer whose account was previously written off. The company estimates bad debts by applying a percentage of 10% of accounts receivable. Wow, that's kind of high. Okay, bad times. All right, so maybe we can start with calculating the ending balance of our allowance for doubtful accounts, and we're told that is 10% of receivables, or 65,000, right? If my math is right. Okay, so we know that whatever we do, at the end of the day, the ending balance of the allowance should be 65,000. Okay. All right, so they want us to prepare journal entries to record the write-off of receivables and the collection of the 1,700. Okay, so we can do that. So when we are actually, we have a write-off of a receivable, instead of debiting bad debt expense, because we do that with the estimate, we are going to debit the allowance for doubtful accounts. They told us that 23,500 was written off, and we credit accounts receivable, right? There's no point in carrying these receivables on the balance sheet if we are not going to be collecting any monies. Okay, so this is the actual write-off. And then we're told that $1,700, okay, so customer, it was wrote off, and then the customer came back and say, hey, I have the money to settle my account. And so we're gonna have to reverse the above entry, right? Put that 1,700 back into the receivable, put it back into the allowance. And then we can accept the cash. So debit cash of 1,700 and then credit the AR for 1,700. Okay, so in terms of an account that was written off previously and now they are making a payment, it's a two-step process. Okay, first we have to put the accounts receivable back and the allowance for doubtful accounts back as well, and then we debit the cash and credit the receivable, just like as always has been done. Okay, and then the last step is to find out what exactly do I need to adjust for bad debt expense, right? And to do that, I have to analyze the movement of the allowance for doubtful accounts. So I'm going to have my doubtful accounts. We already said a credit increases this account. This account had a beginning balance of credit, right, of 37,000. So that's the starting point. And then it looks like we debit 23,500 with entry 1. And then we credit 1,700 in our journal entry 2. And so the ending balance right now is, so what is it? 37 minus 23, 17, 15,200. 15,200, and we said it needs to be 65. So since we have a net credit balance, then we subtract and coming out to the adjustment. So I have 49,800 as our bad debt amount. Right? Because if I increase this account by 49,800, the ending balance will be 65, and that's what it needs to be. Okay, so I'm going to debit bad debt expense for 49,800. and credit the allowance for doubtful accounts for 49,800. Okay, so that pretty much sums up the number 1 requirement, and then we have number 2 where we have to recreate our partial balance sheet. So we're going to have our accounts receivable. The gross amount of the receivable is, I don't have an amount. 650,000, right? Less the 1,700. Oh no, I'm sorry. Is 650,000 minus 23,500 minus 1,700. Oh no, because the 1,700 was a wash. We put it back, then we took it out, so that was a wash. So I get 626,500. And then less the allowance of 49,800. So the net amount, no, that's not, I'm sorry. I should be looking at 65. So 626,500 minus 65 is not what I wanted it to be. Okay, let's look at this again. The accounts receivable has 650,000, right? $65. And then we did that journal entry. Minus 65. Okay, I'm getting $561,500. Is that right? Okay. All right. And continuing on, I only have 5 minutes. By continuing on, we have our note receivable. I think in the first case is an interest-bearing note receivable. That means that we can calculate the interest. So there will be no difference. So on when we first issued the note on June 30, we're gonna debit notes receivable for 40,000 and then credit sales revenue for 40,000. And on December 31st, we have our interest receivable, interest revenue. And the note is actually for how many months? July, August, September, October, November, December, January, February, March. 8 months. Multiply by 5%, multiply by, so that's July, August, September, October, November, December. We have 6 months. So the interest is 1,000. So that will be debit on December 31st. We're gonna debit the interest receivable for 1,000 and credit interest revenue for 1,000. And then we have the March 31st. That's when they actually paid the note. But I kind of wanted to go into this one where the interest is explicit. And so the difference between the note and the merchandise sales price is going to be our discount on note receivable, which is the 2,400. So on June 30, our entry will be slightly different from the previous one, in that we have our notes receivable for 40,000. We have a credit to discount on note receivable of 2,400. And then we have our sales revenue for 37,600. All right. And so when it comes to December 31st, we are taking, okay, so the 2,400 is for 9 months, right? So from June 30 to December 31st, there's 6 months. So we multiply that by 6 nines, and that will give us the amount that needs to be accrued. So 2,400 multiplied by 6 divided by 9 is 1,600. So when it comes to December 31st, we're going to debit the discount on note receivable for 1,600 and then credit the interest revenue for 1,600. And then when we pay the note, or when we the customer actually pays us for this note, then we're gonna have to debit our discount on note receivable for whatever balance is left in there, which will be the 2,400 minus the 1,600. Ooh, we have to go. Or I have to go. Which is 800, and then credit our interest receivable, and then debit cash and credit the note receivable. Okay, so that's that. This problem is similar to what we've done, except that they're asking you for accounts receivable net, but it's pretty much the same with the allowance and all that. So you should be able to figure this out. All right. Are there any questions before we leave?